Hello and welcome everybody. Here we are tonight for our broadcast. We have an amazing panel lined up and we are actually out on the road. It's a little bit noisy and I really hope that you can all hear us okay. It's a bit of an experiment. Tonight we're at Chuck's Roadhouse here in Wasaga Beach. As many of you might know, I moved up here just over a year ago. My friend Lee Schaffer, portfolio manager, one of our guests tonight, he moved up to Innisfil a few months ago, just a hop, skip, and a jump over on Lake Simcoe. He came over, and we have George Watson, who's here with us. We're very pleased to have George. George is a town councillor here in Wasaga Beach. He's a resident of Wasaga Beach. He has lived here for 50 years. He's only 51 years old. No, just kidding. He's a young man and he's a great guy, and he's also a real estate agent, an appraiser, and a mortgage broker. Semi-retired, I think at this point, but still very active as a town councillor. And we're pleased to have him with us tonight. We also have with us online, we have Jessie Yang. And Jessie is from a company called Avenue Living. And Jessie, are you there with us?
Yes, I am.
All right, great to have you. So we have Jessie with us on Zoom. And so without further ado, let's kick things off. So the main topic for tonight's broadcast is how to invest in a rising interest rate environment. I think that's the key, right? I mean, everybody's always thinking about the real estate market. What do we do? Do we buy more properties? Do we buy more properties and keep on buying? Do we lend our money for mortgages? But let's face it, a lot of people have their money in the public market. Some have it in the private markets. We're going to talk to Jessie about private markets a little bit later on in the show. But I wanted to talk to you. He's a portfolio manager who's coming out to a lot of our events that we had in Toronto before we moved up here to Wasaga Beach. And very, very knowledgeable guy. And I'm sure people are asking Lee every day, Lee, what do we do? Should we be selling our portfolio? Should we be buying more? Should we be buying gold? Should we be buying Bitcoin? What do we do in this environment? There's a war in Ukraine. Interest rates are going up. Lee, what do we do?
Fantastic. Thank you, Dave. Background, Dave and I have known each other for several years. Dave and I met when we lived in Vaughan, and as Dave had mentioned, he's moved up here
Beside the beach.
Beside the beach, exactly, and I moved beside the beach in Innisfil. And I've been with RBC Wealth Management for about 22 years now. And so this is an interesting topic, Dave. Thank you for having us, and thanks for everyone for being here. I think one of the key issues is how do we navigate investing in a higher interest rate environment? So what should we be doing? Well, we all know that real estate, we believe in diversification. A lot of what we do is what we call comprehensive wealth management. So we're talking to clients about, public markets, about the private markets, about mortgages, about real estate, in trying to formulate a plan as to what they should be doing with their wealth. And tax savings is a big part of what we do as well. And what comes to mind is, you want to protect yourself against inflation. So how do we do that? How do we protect ourselves against higher rates, higher inflation? Well, we know that there's several ways to do so. One might be, to own real estate, okay, and another might be to own public equities. A third might be to own private investments, private real estate, and we know mortgages, are a great way to capture yield. So, with that, there's a lot of opportunities. The question is how much risk and how much reward are we looking for? So, as a risk manager, we always assess and ask ourselves, what is the risk? What is each unit of risk we're taking to get each unit of return? So what kind of risk do we have to take to develop, to get the return we want? So we'd like to look at a basket of multitude of assets to ensure that we're, ahead of the game, and provide a financial plan or overview with that, strategy.
Okay, so, but do you see, like, recently, is there movement? I mean, equities listen, I recently went out, I invested in a portfolio. It had a heavy bond weighting because it's a short-term investment. We recently had a guy on the show talking about buying for free a condo in Costa Rica. I mean, free in the sense that you got. Whatever I had, I put it in short term, and wouldn't you know, I put it in and it goes down. So doing okay? We're doing great. Thank you. Yeah. So what do we do? Like, there's been some movement lately. Do we buy more of what's going down? Do we sell? Do people ask? Do people come to you and say, "Hey, I'm holding. Do I have Russian stocks in my portfolio? Should I be selling them? Should I be buying more of them?"
Well, it's a good question, Dave. I mean, I think the integral issue is not so much, we tend to react sometimes, and sometimes it's too late. And if the question is our bond, like the Bank of Canada is meeting in April, and the question is are we going to see continued interest rate increases? The consensus is yes. With inflation, the Bank of Canada is going to have to increase rates. The question is how much and how fast. And if we knew the answer to that, I mean, if we had a crystal ball, obviously we would act accordingly. The truth is nobody does. What we do know is that we've got 100 years of data to look at, and I'm always looking at bond yields and the 10-year bond yield to try and assess where interest rates are going. And the one thing that central bankers have said to us over the last year, and although they have retracted somewhat, but the one thing they've said to us is that this inflation thing is transitory. In other words, it's not necessarily sustainable. Who knows? But the question is are they going to have the wherewithal to continue raising interest rates, and bond yields will continue to go up and bond prices will continue to go down? And is that something that's going to be the trend for the next several years? I'm not sure I believe that. Mm-hmm. So should one switch gears? Well, the question is it depends upon, if one needs the money, or if one, should one double down? Bonds are a tough investment these days. We have cash instead of bonds. We have some bonds, but they're generally short term. We tend to look at, mortgages or fixed assets, paying higher yields in order to get bond equivalent yield, in order to get decent returns, and so which could include mortgages, which could include some high yield bonds, and those are some asset classes we've looked at. So the question as to whether to switch gears is really dependent upon one's personal circumstances.
So by switch gears would mean what? Change the weighting? I mean, I think the conventional approach in the business is that you, like, as far as public assets go, you would normally invest based like a certain proportion into bonds, a certain proportion into stocks, depending on your risk and your time horizon.
Correct.
Right?
Correct.
So does that change now for people, given this current economic climate with rising interest rates and a war in the Ukraine?
Well, it's interesting. I mean, especially with the war in Ukraine. I mean, a month ago, we may be saying something very different from what we're saying now. A month ago, people were nervous because of what was happening. We looked at data. I mean, I'm with Royal Bank, and we looked at data over 50, 100 years of wars. And what was interesting is when you're in the height of a pessimistic mode, that's actually the time to invest. So we deployed some capital while the market was low recently into some good well-run equities, because we felt that there were some lows. And now the market's coming back because it looks like they're talking in Ukraine. There's some talks going on now. So we may get through this. And then, the equity markets will continue to rally. The issue is really what is the short term and the longer term outlook. And I think in the short term, we still have pressure on yields, meaning yields might still rise a little further, you know, but the thing that people forget sometimes is that, pension funds are fully funded at a certain level. So the institutional market doesn't need higher yields beyond a certain stage. So, beyond 3% yields, the institutional market or the pension fund market is fully funded. So it's hard to fathom much higher yields, much more than what we've seen. So I think that if you've lost money because you own bonds and you don't need to sell, you can afford to wait.
Yeah.
On the other hand, would I double down? Not necessarily, because there's still risk there, right? And of course, if it's for the longer term, we want to be in real estate. We want to be in equities, because inflation is a legitimate concern, right? We all see the price of goods going up tremendously. What does gas cost? What does groceries cost? So, when they tell us inflation is 2 or 3%, it's hard to justify that when people's homes are up substantially. The cost of groceries is up substantially. The cost of gas is up substantially. I mean, those are three big components. So obviously we have a need to combat inflation, and that's what people should be investing in.
Right. Would anybody have ever thought that when COVID hit, and we thought all hell was going to break loose, not only real estate prices, but the stock market has rallied. What do you think has caused that to happen? And it sounds to me like you're saying stay the course. I mean, it's not a time to sell.
Well, going back the last few years, and that's the Toronto Maple Leafs scoring again. So, going back a number of years, central banks have injected a lot of liquidity into the markets.
Yeah.
Okay. We all know that interest rates have been brought down to zero. Okay. And we've had a situation where central bank bond buying and has caused everything to rise in price. So everything has gone up. So the question is now, is that changing? Okay. Are we in an environment where they're going to withdraw? Well, they are withdrawing stimulus. They've already stopped some of the bond purchases, and interest rates are clearly going up. So the question is not so much is it going up, but how much is it going to go up and how fast? But the withdrawal of stimulus concerns me. We still have to be somewhat cautious. You talked about the ratio of equities to fixed income. We've always maintained, 65-35, 65 in equities, including real estate, and 35 in fixed. And we haven't made major changes to that model because, it's difficult so we've worked around the edges. Okay. We tend to, when prices come down, we tend to add a little more. And when prices go up, we tend to pull back a little bit. But we don't move too much around from that model because it's worked over time, the 65-35 model. So we tend to stick with that, unless somebody's really risk averse, we'll have a much lower equity percentage, or if somebody's looking for higher returns, we'll have a higher equity percentage. But the reality is the withdrawal of stimulus concerns me. It concerns me for real estate prices, and it concerns me for equity prices. I think that we may have to be in a position where we can absorb, where we're more comfortable with taking on risk, or we have to be in a situation where we have to modify our expectations. But I think that with the stimulus withdrawal is a concern. It's a legitimate concern.
Right. Okay, gotcha. I will mention that, we had a comment about the background noise. Unfortunately, we can't really control the background noise too much, so we hope it's you're able to hear us at home, and it's a bit of an experiment, so we appreciate your patience. Tonight, we thought it would be fun to do something out here at in a restaurant. We had a little bite to eat, the three of us. Okay, so we'll come back to our conversation with Lee Schaffer, portfolio manager. Lee, what is a fellow of the Canadian Securities Institute?
Oh, you have to ask somebody who was. No. It's as everybody knows, we're governed by regulatory organizations, much like the real estate industry is and private equity, and our governing body is most of the exams are through the Canadian Securities Institute, and the Canadian Securities Institute requires us to have, beyond a securities license, a portfolio management license, and we become members of the institute. Okay, FCSI, fellow of the Canadian Securities Institute, simply implies that we have obtained various credentials that allow us to be a, shall we say, an alumni of the Securities Institute, to lack of better words.
Yeah.
Yeah.
Okay, got it. And you're a senior portfolio manager. Lee is a very experienced guy. He deals mainly with higher net worth individuals, but give us a call. Call me, and if you want to work with Lee, give me a call first, and I'll see if he can take you on. He doesn't want to appear like a snob, so he doesn't say things like that. But I just want you should all know I really appreciate him coming here and participating, because he's a very experienced and knowledgeable guy. I know he's done great work for a lot of seasoned investors, and very knowledgeable. So appreciate it, and don't go anywhere, because we'll continue to have this dialogue. But let's bring Jessie into the conversation. Jessie, let's unmute you if you're. Let's see, Jessie.
Yeah, I just unmuted myself.
There you are. Okay, so Jessie, welcome. Good to have you with us. So Jessie is with Avenue Living, which is a private equity company. They have a lot of apartment buildings, is mainly what they invest in residential real estate. Primarily, they have properties out west in the Prairies, and they also have holdings in the United States. And one of the reasons that I wanted to bring Jessie into this conversation was because with inflation the way it's going, and rising interest rates, if you're an Ontario landlord, especially, you might be scratching your head saying, well, what do I do? I'm only allowed to increase rates or rent by 1.25% per year. How do I navigate in times when inflation is as high as it is? What are some of my options? Because a lot of us really like investing in real estate, and that's one of the reasons I wanted Jessie to join us. So Jessie, welcome. Tell us a bit about your company, and also about yourself, and how do you help people to address that particular challenge?
Sure. Thank you, David, and thank you for having me on today. So essentially, I can tell you guys a little bit of Avenue Living before we go back to that very important comment with regard to inflation. So Avenue Living is a alternative asset manager. We focus on specifically invest into real estate. That's just not only it's not limited only to residential, but also we have asset exposure to farmland, self-storage, etc. So total asset under management under Avenue Living umbrella is about 3.5 billion. And then it started back in 2006, currently in business for over 16 years. So as a whole, you can think Avenue Living as a asset manager focused on investing in real estate on behalf of our institutional investors, retail investors, high net worth investors, on selecting investment opportunities and being able to manage them altogether, because we are a integrated platform. Not only we are a asset manager, we also manage and then do property management ourselves. A little bit about myself, Jessie Yang, currently a CFA charter holder. So I've been in the private, I would say private alternative or private real estate, private equity market for the past 10 years. So predominantly in the real estate space, in all the areas I just mentioned. So being with Avenue for more than a year, been enjoying the journey so far, and it's been a great opportunity to be here to kind of introduce you guys, and then also just talk about what's currently happening in the market, especially as David mentioned, we're facing with 5% inflation rate on an annual basis. So as you guys know, I actually wanted to go back a little bit. When it comes to inflation, people always talk about, okay, why we need to invest in real estate when it comes to inflation. The idea is really simple. When it comes to inflation, traditionally, real estate as an income producing asset class is able to hedge inflation pressure by being able to index that rent income close to inflation. Meaning, let's say if everything goes up with regarding to maintain a property when it comes to cost and expenses, you being an asset manager, you being a landlord, be able to increase that rental income. You'll be actually pass on that all the expensive costs to your tenant. In the way of hedging that inflation. That's traditionally why income producing properties are able to do so. However, given the certain, I would say, rent control or government policies in Ontario specifically, as David mentioned, this year as a landlord, you'll only be able to allow to increase your rent by 1.2%. Virtually, if you're talking about one side being the revenue side, you can maximally increase by 1.2. Whereas the cost side, you're talking about, virtually inflation around 5%. You can do the math. It really doesn't make sense. Whereas particularly we focus on, Avenue Living, we focus on Western Canada. Essentially, all the geographics that we focus on has low or no rent control. What do we mean by that is that, given any single day, if we were to be able to see a cost of, running the business go up, we are able to index that rent to inflation to be able to hedge that risk. Because essentially, running real estate is like running any sort of business. While, all of your costs and expenses of running that business going up, you got to be able to find a way to really increase of your revenue to really keep that bottom line flow. So yeah, that's a little bit about Avenue and myself. Yeah, over to you, David. I don't know if you have any questions you want to specifically ask.
Yeah, okay, very good. Thanks for that, Jessie. So the Prairies, I know that one thing as far as the positioning of the type of assets that you hold, you're holding what the terminology is B and C assets. So I guess that means what exactly B and C assets? And what was the other term I saw in the presentation? It was about something about like catering, workforce housing. So why is that important? Can you help us to understand who are the tenants, and can investors count on a steady income from the portfolio or from the investment?
Yeah, for sure. So essentially, when it comes to asset selections, we're particularly focused on, I would say, Class and B and C assets. In other words, low density assets are typically tailored to what we call workforce housing group. So they represent, I would say, more than 30% of the Canadian population. So, and they are the group, I would say, are more overqualified for affordable housing, yet is not being able to buy a house in, I would say, short to long term, given the current, market price. So those are the group. The reason we chose those groups as our perfect tenant profile is being a couple reasons. One being, they tend to be a really sticky tenant. Why is that? Because they, in the I would say in the short to long term, they may not necessarily move out. This essentially translates to higher occupancy and higher rent collection. Because at the end of the day, we want a loyal customer. We want a customer who are able to stay with us to ensure that occupancy rate stays high. Another reason is that those tenant groups, I would say, represent more than 30% of the Canadian population. When they come to rentals, what we call they rent by necessity, but not by choice, meaning that they are actively looking for a place to live for rentals, not necessarily meaning that I have to pick a place because right now I wanted to live in a rental apartment. So a lot of times when they come to affordability issues, they are well above our what we will call a 30% threshold. So in the real estate business, particularly in the multifamily, if you are a landlord, typically a safe, I would say, margin is that you're looking for your tenant's income, like your rent you're charging, typically you're looking at maybe 30% of your total tenant's income. Whereas, within our demographics, we offer housing that's with better qualities, but still affordable. So what I mean by that, if you're looking at our tenant pool, that percentage is about 20%, meaning that their income is about 4 times of the rent they're paying. So not only we're able to increase the rent in real time because we typically operate in the rent no to low rent control area, but also you got to look at, if you were to increase the rent today, are your tenant able to afford it? Are they going to be able to continue to, able to afford their not only their utility bills, but also their rents, right? So another index we're looking at is affordability, which I think, personally, in the next couple of years is going to be a big theme among the real estate market, not only when it comes to buying a house, but also renting a place for you to be able to live comfortably and it's still affordable. So when it comes to asset selection, we focus on this type of demographics because, when it comes to their rent to income ratio, they're still relatively affordable. And then when it comes to their characteristics and personalities, they tend to be a good tenant that stay with us for a longer period of time. So that ensures our occupancy. And I'm proud to say that occupancy right now is about over 95%. And that's to say that we have, 5% of currently our apartments putting offline for renovation. So really strong occupancy rate that really fundamentally driven back to, driven from the demographics and customer we are selecting to work with.
Okay, Jessie, I recently purchased some units of the Avenue Living, and one thing I can say is that I think it's a monthly deposit. Whenever I check the statements, it's like clockwork. Can you tell us about the types of returns that investors have been getting so far? What are the target returns, and also the RRSP eligibility? Like you can invest with TFSAs, I believe, any kind of registered fund. Is that correct?
Yes, David. So when it comes to REITs, so think of it as a REITs. Essentially, we're a private REITs company. So when it comes to return profile, such as like you are investing in real estate yourself. So a lot of times the rental income that we collect, we're able to pass through to the investor himself. So that's in the form of dividends. So what we call distribution, that's get paid monthly basis. And then currently we're paying about 5.66% on annual basis when it comes to distribution. And the one thing I really wanted to mention is that because you're investing directly to real estate through a REIT vehicle, you'll be able to enjoy a tax benefit, tax advantage because of our distribution are treated as 100% return of capital. To summarize it simply, essentially for the year you receive distribution, you don't have to pay tax on it. And then those distributions will actually use to reduce your book value. So once you redeem the fund down the road, you'll be subject to capital gain at that time. And that's 50% of the taxable income you typically occur. So it's fairly tax advantageous for especially real estate investors. Think as if you were to invest in your condo somewhere, essentially the income you're getting is, 100% taxable income. And then another benefit is that you don't have to worry about managing the tenant, right? We are a real estate management company. We manage portfolio over 13,000 and 1,200 units across Canada and into the States. And then they enough to provide you with a diversification benefit, which you typically don't have access to. And it is also eligible for RSP, TFSA money as well. So compared to, let's say, if you put the money for a down payment for an investment property, is a lot easy or flexible to use because you are able to use those registered monies for your investment.
Okay, so I heard you mention a return somewhere between 5 and 6%, but that's the return on capital portion, and you may have touched on it, and maybe I didn't hear. I apologize. There's a fair bit of background noise still here in the restaurant, but I think besides the ongoing return that you get, the distribution, which is treated as which is considered return on capital. In addition to that, there's ongoing increases to the net asset value. So I mean, investors have been getting more than 6% traditionally, have they not?
Yeah, for sure. I mean, that's a really good point I forgot to mention there. So on top of the distribution you would typically get, which get paid on a monthly basis, there's also what we call the capital appreciation associated with the investment. So think as the value of a entire portfolio were to increase or appreciate, that appreciation was also passed through to our investors, treated as capital appreciation. So traditionally last year we had a total return of 10%. That's represent about over 10%. So that represents about 5.6 to 6% of distribution. The rest counts as our capital appreciation. Our long-term target return for the fund is in between 8 to 12% on an annual basis net of all the fees. So that's another essentially things that you should really consider as when it comes to total return profile. Not only you'll be enjoying the distribution part, which are 100% return to capital, but also there's a potential capital appreciation, which typically able to capture the capital gain associated with the value of our properties.
Okay, so returns, when you consider both the ongoing distribution and the increase of the value of the portfolio, the returns, the target is 8 to 12. How has it been performing, let's say, in the last few years? What have investors been seeing?
For sure. So our last year, just give you an example, our 1 year since past year average is 10.09%. The year before 2021, we had a 9.63%, and a 2-year average about 9 to 9%. So since inception, that's been in the market for about 4 years. Our target return, our achieved return has been over 7%. So you can see consistently it will be targeting between 8 to 12, and then we continue to see that there is uplift in the valuation of our properties as we grow into a bigger fund. And then when it comes to, I just wanted to quickly mention one thing that I forgot to mention there. As a mutual fund trust, a lot of times you are exposed to the diversification benefit, which may be very critical in this time, because we all know the past year the housing has going absolutely over the roof. And then one thing about us, because it's work as a REIT and work as an asset manager, you'll be able to access more than 20 markets across Canada and the States. And that essentially hedge a lot of risk when it comes to diversification, because the more assets you have within the pool, and then not particular location, not a particular asset class will take you down. So essentially that provides you with a lot more diversification benefit that you could possibly get from an institution, from a retail investor standpoint. Sorry, David, I think you're on mute.
Thank you. Do you want to comment on private equity in general, specifically in Ontario? Because I mean, it's one of the reasons I got into the business. Some people may not be aware that in addition to being a mortgage broker, I'm also a dealing representative. And the laws changed in 2017, I believe was the year in Ontario, where the doors opened up so that you didn't have to be a super high net worth individual to participate in these kinds of private investments. Because with the new types of investors being like an eligible investor, do you want to maybe touch on that a little bit too?
Yeah, for sure. So traditionally, I mean, private equity has always been offered to what we call the high net worth family office institutional investors because it does provide one being the stability that you typically don't get from the public market. Private market tend to have a less correlation with the public market. So therefore, a lot of times institutional investors will allocate, I would say 30 to 40% of a portfolio actually into the portfolio, into the private equity in order to hedge that volatility risk. That has been traditionally being the case. And if you look at either CPPIB or Teachers Pension Plan, one of the biggest pension plan in Canada, they allocate more than 30% of the allocation into the private market, whether it's private real estate, whether it's private debt, whether it's private equity. So because they traditionally provide a diversification benefit and it's not subject to volatility, it provides stability. Simple as that. And then as it evolves over the past couple years, a lot of what we call accredited investors, eligible investors, are able to access this type of assets, meaning that you just need to meeting the certain requirement to be sophisticated enough to be able to invest. But that has been the trend in the next over the past couple of years, and it continues to be the trends going forward because essentially, everyone needs a diversification, whether it's public or private, and then that has been demonstrated in the pension plans allocation as well. So I will say going forward is going to be the trend, and then accredited investor is needing the private equity or private real estate invest is more important than ever, especially given this time.
Yeah, that's great, Jessie. So I just want to reinforce something you said, and maybe just put a little additional perspective on something you said earlier with respect to the returns. You were talking about the ongoing distributions and the return on capital and how that works, because that may be a new concept to a lot of people. Also, you use the term REIT, and just to be sure, REIT is a real estate income trust, and the legal entity is a mutual fund trust. And when people are earning a return on their money, there's different ways they can earn a return, including interest, including dividends, and capital gains. Those are the most common ones that people know about. So with return on capital, it's a preferred treatment. I guess ultimately you're going to have to pay the capital gain because it lowers your cost base, but it defers any tax that has to be paid until you sell the investment, as I understand it. And so in the meantime, you're earning income, these ongoing distributions in a very tax preferred way, because capital gains is in fact the most preferred way. Better than interest, which is the worst, and then dividends, and then capital gains. Is that a proper summary, would you say, Jessie?
Yeah, that's absolutely correct, David. So essentially return of capital, think as of a tax deferral treatment. So instead of getting taxed today, essentially, and then not getting taxed by 100% of the income you receive, you effectively defer it until later you redeem the unit. And then that distribution amount is used to lower your adjusted cost base, and then whatever the capital gain you will be actually being occur down the road is actually treated as not income, but also capital gain typically is treated 50% as taxable. So it's, I would say, one of the most favorable tax treatment within Canada.
So that's great, Jessie. Thank you very much. I think you did a great job explaining it. As I mentioned, I'm personally invested in Avenue Living. I like it very much. I like the people who work for Avenue Living, including yourself, of course. and the business approach and the philosophy. If people are watching and they want to learn more, they can give me a call and I will speak to them about it. For every potential investor, we will do a proper assessment to see, you know, what are the proper needs. There's some people don't realize that there's quite a bit of rules under the Ontario Securities Commission in terms of how much money people can put into private equity and how much they can be concentrated in any type of particular industry. They shouldn't be everything should not be in real estate. And everything cannot be in one particular investment. But Avenue Living is certainly one that I like and have invested in personally. If people want to learn more about it, they should give me a call. And thanks a lot again, Jessie. Maybe next time you'll join us here in Wasaga Beach, but we'll find perhaps a quieter place. I hope you're able to hear me okay. So we appreciate you joining us tonight.
Yeah, absolutely. Thank you, David.
Okay, so now we're going to have a little conversation with George Watson. George Watson, as I mentioned before, he is a counselor here in Wasaga Beach. He has lived here in Wasaga Beach for 50 years, 50, that is. 52 years. And he's also been working as a real estate agent. He's owned real estate brokerages. He's worked as an appraiser, and he's worked as a mortgage broker. So he has seen quite a wide variety of activity in the real estate industry. If you're somebody who works in the industry or has a particular interest in the industry, there's a lot that you can learn from George. So first of all, George, tell us. Let's start off a little bit about Wasaga Beach in general, because I know that Wasaga Beach is growing, and it's considered the second fastest growing community in all of Canada. What would you say are some of the key reasons that is happening here in Wasaga Beach?
Thank you, David, for having me here this evening. Wasaga Beach has been growing probably the last 4 censuses that we've gone through in the country, last 4 censuses or so. Wasaga Beach has been probably in the top 10 growth counts for our size on a percentage basis. One of the fastest growing communities all throughout that period of time. This past year, our building department reported statistics that we broke all of our previous records for the municipality. A lot of those records were set in 2004, which was even a surprise to myself. And I'm thinking, well, we were hopping back then, and we've continued to go with it. And the last census that came out is we're just a shade 150 people below 25,000 now as a population for Wasaga Beach. So we are going well. And some of the reasons, I guess, are the lifestyle. Number one, it's a lovely community, water oriented. We have a river going through it. We have Georgian Bay going through it. Our largest landowner in Wasaga Beach is Ontario Parks. They own and control 4,600 acres along the beachfront in the middle of town, and that's all protected land. It'll be protected forever. We have, if you fly over Wasaga Beach in a small plane, you'll see the tree canopy that we have here is unbelievable. We have millions and millions of trees throughout town, and that is going to stay that way with the parks. It's protected land. It's never going to be built on, and that's the way we're looking at it. Wasaga Beach is, I believe, in visitor numbers, is the busiest Ontario provincial park in the province. We average about 1.5 million visitors in the provincial parking lots every year. It varies. Sometimes if it's a real hot summer, we'll gust up to 1.7 million. If it's a miserable summer and it's very weather related, you might go down, but on average, about 1.5 million visitors, and that's not counting our municipal parking lots. So I would dare estimate that our tourism attracts probably 2.5 million people a year easily into Wasaga Beach, which is a nice boost to our year-round economy.
That's pretty amazing, George. So, I mean, for you looking back, what were some of the highlights for you, let's say, either in your life or your career, 50 years here, living in Wasaga Beach, and how did you first decide to get into real estate?
Well, I had the good fortune of, my family's been in Wasaga Beach since 1960, so I think we're looking at 62 years. And my parents moved up here in 1968, and I finished high school in Collingwood. But I had the good fortune of getting a summer job in Wasaga Beach when we moved up here. And the gentleman that I started to work for was a real estate broker. He had a very large brokerage. This was pre the franchises. You know, most real estates at the time were, you know, David Grossman Real Estate or something. There were no Remaxes and all the rest of it. And we started with him, and he was also the Reeve of Wasaga Beach, which we were a village at that time. A lot of people maybe don't realize Wasaga Beach has only been a town since 1974. We're a very young town. We're not like a lot of traditional Ontario towns that have been around 150 years or something. We're literally less than 50 years old. And as a village, the Reeve was, in effect, the mayor, you would call him now, but there was a Reeve, a deputy Reeve, and councillors at the time. And so between him being a realtor and the Reeve of the municipality, it really got my interest going, and an interest in politics and real estate both.
So you got into real estate. When did you get into politics?
Well, I got into real estate around 1972, 73. I got my first real estate license, and I was only able to get that because the age of majority dropped from 21 to 18 at that time. If you recall, back in the day, to vote you had to be 21, to drink you had to be 21. So the age of majority dropped when I was about 19 years old. So I went and took my real estate courses over the course of a winter and obtained my license, and I started in real estate in 72, 73. And politics around the same time.
Yes.
Around the same
I
time.
didn't know that. So you've been in politics for almost as long as you've been in real estate.
Dabbling in it. I actually ran for mayor in 1974 against a gentleman that we became very good friends later on, and I was not successful at the time, but that sort of whetted my appetite to continue.
I see. Gotcha. Now, what inspired you to not only work as a real estate agent and a broker owner, because you owned an office at one point, but also to get an appraiser license as well as the mortgage broker license?
Well, they all sort of dovetail together at one point. The mortgage brokerage part, just to go back a little bit of history, back in the 70s, the Real Estate Business Brokers Act was also the Mortgage Brokers Act. They were one and the same document. So effectively, if you got a real estate license, you had a mortgage license to go with it. They eventually separated those, and the mortgage brokerage industry got their own acts through the government and real estate. But anyone that was a realtor, if they wanted to, they were grandfathered into being a mortgage broker at that time. You had to apply and give them your experiential work. You still had to do all your education updates, as you have to do in real estate. You just can't get your license and forget about it. There's continuing education in all these disciplines. And as far as the appraiser's part goes, the appraiser license again worked well with real estate. And again, There's the Appraisal Institute of Canada, which is sort of the granddaddy of them, and then there's the Canadian National Association of Real Estate Appraisers, which I was a member of both of them at one time. But I continued on with that, and again, the education part of it, you had to keep up, keep up with your credits all the time. If you didn't accomplish those courses, both real estate, appraisal, and mortgage, then you lose your license. So, as you know, as a mortgage broker, you have to do it, and you know yourself, you probably have to keep doing, continuing.
There's continuing education,
Yeah.
excuse me, as well as a multitude of licensing requirements.
Yes, exactly.
It's getting more and more rigorous, which is probably a good thing, I think, for the consumer ultimately.
Yes.
We were speaking earlier, before we went live, we were talking because, I think a lot of people have been buying real estate and they're very, very bullish on real estate, but they may forget between 1990 roughly and the year 2000, real estate prices didn't go anywhere.
No, you're absolutely right, David. And that's what I worry about is I listened to Lee talking about the stimulus the government put in. Who would have thought when the pandemic hit, none of us had lived through it, unless you were born in, lived through 1918 and the Spanish flu. But who would have thought that real estate came to a complete halt for a couple of months, COVID, and then it took off. It's crazy. Who would have thought the stock market would have done as well as it did? Again, it went down. There was big losses at the beginning of the pandemic. You had to ride those things out. It's all on paper. Lee will tell you that. So if you sell, you've lost. If you keep it, you're hopefully going to go back up again. So big surprises to myself in both things, stock market and real estate, how it rebounded and took off crazy. We're talking 30% gains over the last 12 to 18 months in real estate, right across the country. I don't think any place has been not affected in that regard. Some places more than others, but it's been a good ride.
Yeah, I think that perhaps underscores the need for diversification in any portfolio. If you go nuts on any one thing, it could come back and bite you sometime. So, nothing like diversification, real estate, and having other holdings too. Absolutely.
I heard Lee talking about that. It makes sense. You can't put all your eggs in one basket, as they say.
Right.
So you need that balance of your portfolio, whether it's bonds, stocks, GICs, real estate. Up to this point, I worry about, Lee's worried about the stimulus ending, and so am I, but you worry about the government getting their hands in too far on things. You hear of, you're hearing non-resident taxes now, vacant property taxes. There's been some talk of tackling the sacred cow that's out there of your principal residence is tax-free, you're sheltered from taxes. There's been talk about trying to hit that, which, that would be devastating.
Right.
That's, people bank on that as a nest egg. And I've seen it in my decades in real estate. The capital gains tax came in. They put it up, then they had to lower it. They brought a speculation tax in the early 80s. That was terrible. They got rid of it because on top of you're paying capital gains tax, speculation tax, there's no incentive for anyone to do anything. So I worry about the government getting too involved and really curtailing the market. Interest rates are going to go up incrementally. But if they do the wrong move, it could be devastating.
Right. Yeah, that's a very good point, George. Absolutely. So what were some of the biggest changes you've seen over the years? Things which, besides the prices and how they were impacted between 1990 and 2000, but just generally in the industry, and some of the biggest changes that may have affected you. Any special lessons learned that you might share with people who are either starting out or who have been in the business for a while, from some observations that you have made?
Well, in the industry, the biggest changes have been technology. The technology has been unbelievable. When I started in 1972, there were no cell phones, there were no fax machines. I was putting hundreds of thousands of miles on my vehicle, driving to Toronto and back, taking offers down. You know, you couldn't, you had to meet them at their home. Sometimes you'd drive back and forth from Wasaga Beach to Toronto a couple of times a day with sign backs on offers because you couldn't fax it, you couldn't do anything. Nowadays, you look at a listing, you've got drones flying over the houses, you've got 3D interior shots of the homes. It's just unbelievable how the technology has changed this industry. Everything's online. You have electronic signatures. You don't have to leave. You can work from your home. You don't have to work from an office. It's just unbelievable, those changes that have happened. And going back to your point about 1990 to 2000, that was it's like someone dropped the curtain about Christmas of 1991, and the market dropped substantially. People have bought it at the tail end. Just before that happened, it took 10 years for the prices to get back. If you had to sell before that, you lost money. It took a good 10 years for it to come back to about 1995. The drop stopped, it started to stabilize, and then it's been generally going up from then. Then we had 2008, of course, which was a big hit to a lot of people also. But, you have to look long term, whether it's a stock portfolio or whether it's real estate.
Do you remember how much prices dropped? Like, let's say from 90 to 95. Was it as much as 25% or was it less than that?
I would say it was at least 25%. Yes.
That's pretty steep.
It was.
If you're buying a property with 25% down, hopefully you can hang on, because otherwise you've lost all your equity. People forget that when they think about.
Well, they do. Well, 2008, they call it being underwater with your mortgage, and it wasn't so much in Canada, but Florida is an example. A lot of places in the States, or Florida in particular, people were underwater with their mortgage. Their house was not worth as much as their mortgage. You heard about people walking away from their homes, just giving it back to the bank.
Right.
Just, it was devastating. And that can happen.
Well, plus now, I guess it was earlier than that when we had interest rates up 10, 15%. I remember as a kid, I was getting, 12% on a GIC or something like that. That could also be very devastating.
If it ever went that way again, now we were talking, interest rates are pushing 20% at one time. And you're right, on a GIC, I think I had one at 17%. I wish I could have locked it in for 50 years. But yeah, it was what you were talking, a house you could buy for 100,000 or 125. So the dollar amounts were a lot different, but of course, inflation's contributed to that.
Now, George, you're also involved with a number of local associations. I recently joined the Wasaga Beach Builders and Renovators Association. That might be of interest to some people who are watching. That's an association. Are you one of the founding members of that one, Mark?
Yes. I've been a member since the late 1970s. The firm that I worked for joined as one of the founding members, and I was the representative of that company at the time. So I've been there. But I thank you for joining, David. It's you're making a mark in town. You're doing some music and the podcasts, and I hear you're also thinking of maybe a Rotary Club in Wasaga Beach if you have no.
Yeah, I was there last night. So. It's great. I'm really having a good time here. Getting involved in the community, and the Builders Association seems like a lot of fun too. They meet monthly at Rock Dells, which is a steakhouse just outside of Collingwood. Really nice restaurant, and great way to meet people and learn something new every time.
Yeah, we have a nice roster of public speakers to come out to our meetings. We meet once a month, third Wednesday of each month, And we usually have something to do with the construction industry, building officials. This coming month, we have the Construction Safety Association out of Barrie talking about working at heights, how to avoid industrial accidents on the job sites. So that's handy. In May, we're having the mayor of Wasaga Beach speak to give an update on what's happening in Wasaga Beach. So it's a vibrant organization. We're always looking for new members. It focuses on the construction industry, but we have the soft services that go with it, like real estate, mortgage, appraisal, that type of thing. It's also welcome to be a member of that association, along with contractors and plumbers and electricians.
It's great. My timing was good too, because we have the, just right in time for the annual social, had a nice
Yes.
fun hockey game out in Collingwood last weekend. So I've had the pleasure to meet some great people so far in town. And yeah, the first year or so was pretty quiet with COVID and whatnot, but of late things are starting to open up, and it's been very enjoyable. I'm looking forward to a great summer here. I mean, seems like there's going to be a lot happening, and people have a lot of pent up, excitement to get out and go to the beach and listen to music and have some fun. So, yeah, let's hope for a great summer.
The town of Wasaga Beach has a jam-packed schedule of special events this summer, mostly on the beachfront, but throughout town. It's posted on the town website, and we talk almost something every weekend for people to enjoy. And people are looking to get out. They're absolutely looking to go out and shake off the cobwebs and get some good fresh air. And
that sounds great. Very exciting. Well, you definitely have my vote for Councillor George. So thanks for all you do, and thanks for participating in the broadcast tonight. Very much appreciated. And Lee, thank you as well, my good friend. And Jessie, if you're still with us, thank you very much for being with us this evening, and for all of you who tuned in and stuck with us. We really appreciate it. It was a lot of fun. And don't hesitate to reach out to me if you have any questions about any of the conversation that we've had tonight, or you'd like more information about anything that we talked about. Maybe you want to come up and move to Wasaga Beach. So we can definitely help you out. Lots of great opportunity here. Lovely town. I'm so happy to be out of the traffic. You know, that's one of the things. Just driving to the local shopping mall. I lived in Thornhill, drive over to Vaughan Mills. You know, it's like not far away, but just getting out onto the roads, the stress level, I couldn't take it anymore. Driving down, the main strip here, whether it's Moseley or River or whatever, and it's just trees, and it's quiet, and it's really, really nice. So I appreciate George. Thanks for welcoming to the town, and for participating and being me, Jessie, everybody. Have a good night. Next time we do it in a restaurant, we'll make sure it's a little quieter in the background. We hope you can hear us. Judging by the numbers, it looks like people have stuck with us. So hopefully that's a good sign. We do have a recording, so we'll send it out to everybody who registered. Feel free to share it with people, and also if you need a mortgage, give me a call, because that's what I do as well.
Thanks, David.
Thanks very much. All right.
Thanks, everyone.
Have a great night. Take care. Bye-bye.
Thank you. Bye-bye.
Bye.